Okay, I think we're live. Just going to dilly-dally a bit until we are confirmed because I know there is delay. This is the Investing Power Hour number 89 on Chit Chat Money. Welcome in to anyone listening. I know we have no one joining live yet on YouTube, but these shows do go live every Thursday morning, 9:30 a.m. Pacific time, 12:30 p.m. Eastern time on the Chit Chat Money YouTube channel, which if you're listening on the podcast, it will be in the show notes. You can watch the replays on YouTube. You can listen or follow on live there as well, or if you'd rather just listen to the audio, go on Spotify, Apple, wherever you get your podcast. We do not care. But if you want to ask us questions, the only way to do that is in the live chat. On these shows, we talk about anything in the investing world. Could be specific stocks, could be macro, although we try not to do that because that's where everyone wants to talk about. It could be businesses, could be earnings, could be anything. And I am joined, as always, by my co-host Ryan Henderson. Ryan, how are you feeling with stocks pushing towards all-time highs? I think we actually
Upset,
passed it today.
upset, very upset. I just for full disclosure, when we closed our fund, we sent money back to our investors. We were both investors, so a lot of my money was in the fund, and it took forever basically to get that money back. And in that time, basically all the stocks I own ripped, and so I did not get a bunch of the stocks I wanted to own. I was not able to buy them in time. And so unfortunately, everyone's doing well but me. It's funny. It's kind of funny. I know we're not going to talk macro, but we started the fund at the beginning of the fastest, and it's not an excuse, but it is a funny coincidence because we could have invested better. We made bad decisions on our own in our own right. We started the fund at the beginning of the fastest rate hike in history and closed it a month before it sounds like we're going to start easing. So just unfortunate timing all around. But
Yeah. It's not fun to look at. We would have had a good year. Let's just say that a lot of the, it's unfortunate, but all we can do is move on. I don't think people want to hear us complain about that every show. Maybe we can say this is officially the last time we complain about that. But one that I'm looking at is Ally Financial. That like the thesis seems to be coming to fruition. I still think it's fairly cheap. So it's one of those debates where okay, it's gone up about 30, I think, percent, maybe even 40. I haven't looked at the price today. And that's quite a bit of return. That's probably 2, 3 years returns of what you might expect in something that you own. And I still think they have a lot of potential. I still think it's a great franchise, but that it's just the debate of okay, is now a good buying opportunity if I still think it's a high quality business. We do have some commenters joining. John Gallegos says good morning. Good morning, John. He says, what is your current short list of stocks that you're looking at? Thanks. We don't have very many notes today, and to be clear, I think he's not saying shorting. He's saying the stocks that are on our watch list, which I think is actually a perfect question for Ryan and I because we get some cash coming in that we may be buying. Ryan just mentioned that as
yeah, we're
it actually
basically
just showed up
starting
this week. So
starting the portfolios from scrap. So like starting from scratch, sorry. So it's yeah, what's at the top of my watch list? Like Brett mentioned, I think Ally's up there.
oh, dude, I just
Unfortunately,
checked. It's
it's up
up 7% again today.
great.
Almost to
Yeah,
35. Fantastic.
fantastic. Whatever. I, I do think I would be very frustrated if it were like a regional bank I was looking at and that was happening, where it was like one that I wanted to own, where I don't think there's going to be that much growth. And I was like pretty much predicated on valuation. But with Ally, I do think there's a lot of upside and I think they're advantaged. So I think it's cheap. I think they're going to continue to grow depositors. I mean, I was looking at it today from 2014 to 2013. They basically, their retail bank customers went from 800,000 to 3 million. It's a little more crowded today in the digital banking space, but still, it seems like they have a lot of, because they don't have to pay out as much for the physical branches. I think that that savings rate advantage is pretty big, and it'll help them attract customers gradually. Uh, and I think it basically trades at like 6 or 7 times EPS. Not actual EPS, but what they could earn if the interest margin begins to increase again. So, and if rates go down, voila, uh, net interest margin should expand, or it should start to expand slowly. So, yeah, allies at the top of my list. Coupons up there.
Yep,
Nelnet's
I
up
bought
there.
Coupang already. Yeah. What was the other one? Sorry.
Nelnet, but I already owned some of those. I'm trying to think of other ones. American Express is probably up there. God, such a bummer. That list was so full like 3 months ago, and
MX is up to 180. Yeah, I mean that's kind of fills up my watch list for financials. I guess when we maybe hit these first, these are the five that I like, obviously at the right price, and maybe we can discuss which one um you think is the most attractive, or we can maybe debate. Here's the five. Ally, as Ryan just mentioned, American Express, Discover, Nelnet, Adyen. All five, like actually Nelnet hasn't done that well, but uh yeah, those are kind of the ones that I'm looking at that I'd buy at the right price. I think some are kind of close. Discover, I don't know if I'm still sold on it yet, uh, but it's so damn cheap. And Nelnet, as people know who've listened a long time, we followed along a lot. Adyen is definitely very expensive, but still a high quality business. I don't know if we'll get that opportunity again, but hey, who knows? But one of those, I think for right now, given the price, Nelnet looks the most attractive to me at a share price of about $88. I think that's right around book value, but let me check. But what do you think out of those, Ryan?
yeah, it's all concentrated in the financial space. I like all those
That's
discovers.
I went through the financials ones only
Oh,
to
I thought you
start.
were.
Yeah,
Oh,
yeah.
okay. Yeah, I think it's hard to go wrong with that basket approach. The only thing that I'm thinking about here is, so if the reason that they're all up a lot lately is that net interest margins should expand because interest rates are coming down. They don't have to pay out as much as savings rates. To their cost for depositors should come down. But with like the delinquencies and the default rates, or like the net charge off rate for a lot of these, do you think it really helps to have rates down like slightly in this scenario?
Yeah, no, I agree. Or
I
just a
don't think it
slight
changes.
different pro it doesn't change much. No.
Yeah, I wouldn't imagine that it changes the net charge off rate all that much. So I kind of liked it a little more. Obviously, all else equal, it would have been great to hear this if the prices stayed the same, but I liked it more before this Fed rate announcement, because all them it felt like everyone was basically saying like I thought net charge-offs were going to be kind of stable from here, and I think they'll still be stable from here, but now all the stocks have basically ripped because rates are going to come down, so we're getting less return, but
Yeah, and I
whatever.
think that there was earlier this year there was a higher margin of safety in these financials where net charge-offs could increase, and they had if you bought one with a good balance sheet, like they could weather the storm. They're not going to have any problem doing that. And then you have that priced in almost, I would say. And then at the other side of things, if things go poorly, like it's kind of like okay, if things go poorly, we probably don't lose that much money. And then on the other side of things, it's still a good franchise and probably does well. But if, their performance is basically the same as it has been, or maybe even just slightly worse, and they keep growing, the stock is going to do extremely well. But that's kind of generalization. I mean, each one is different. Of course, Adyen isn't actually taking credit risk. It's more of the payment processor. But that one, I mean, yeah. Okay, let's move to other sectors. I got watch lists it just depends how it describes it as a consumer discretionary. I guess this is I don't know why they all get separated into these two, but these two are on the watch list in within there, and that is Airbnb and Coupang. Now, I will say Airbnb, let's look at its year-to-date share price. Uh, one sec. Good audio, good at it. Year-to-date, it's up 74%. So, you know, it's not cheap anyway. And I'm pretty sure the PE is like 40 now. It's not cheap, but Coupang, I think, is highly attractive. I wouldn't be surprised if I bought more over the next couple of months. I really like that one, and we did do a full show on that one. But Ryan, any thoughts on Airbnb?
No, I like Airbnb. I can't really get around the price. It just feels too expensive. Like at that price, it seems like you should probably just own Booking Holdings.
Right, similar business. Yeah, we had a question from that as well. Where Tyler, thank you, Tyler says, wouldn't Booking Holdings be the better equity to own in this period? They are a gross royalty on travel and hotel spending, which should balloon if we don't have a recession. Yeah, and it looks, I don't have the metrics in front of me, and maybe I can pull them up. The stock is typically has been cheaper than Airbnb, which, you know, like is Airbnb that much of a better business than Booking? No, and Booking might be a better business. I've heard some good arguments that Booking is a stronger franchise.
Yeah. I don't know. I'm just looking at this list, looking at my own watch list, and there's a lot of stuff that I once loved, and I just don't find them that attractive anymore at current prices. Sprouts
Which one?
Farmers Market.
Oh,
What is going on?
I think it might be it might be okay. I saw that there was a Goldman Sachs upgrade, but I think what's important for a stock like that to always look is it has a very high short interest. So I think that adds some volatility.
Yeah, it's just getting kind of to an unreal or not unreasonable, but the returns look pretty meager on that, in my opinion. And it's one we followed for a while. It's a business that we think is fine. It's not a great business, but it's fine. But it's trading now at what's the multiple on it? I can't even remember. I remember looking at it at like $40 and or maybe even high 30s, and we basically said like maybe we can get above 10% return here. And it's up a lot since. So I don't know. Doesn't feel that attractive to me. One I do
Okay.
like though, no
I
matter
was gonna
go ahead.
I was gonna close the book on Booking and Airbnb before we move on. Airbnb EV to EBIT 29.4, so basically 30, Booking 16.2. So that's a big difference.
We should cover Booking on a show. It
We
sounds
should
really
make it.
attractive. I've heard or I've seen some commentary from the management team. It seems like they're kind of rock solid. So I think that would be a fun one to visit. Other company, Philip Morris. I still think Philip Morris is in a good spot. And just in general, it seems like people are just like with the whole rate announcement yesterday, and we're still talking about macro, but with the whole rate announcement, it seems like everyone thinks like we're back. Consumer spending is going to like rebound. I don't think it's going to make that big of a difference. I really don't. I think people's budgets like are still pinched. We're not in the same spot we were in 2020. I don't think we're going back to zero. So it feels weird to me that all these travel stocks are kind of bouncing because of this. Whatever. Big tech doesn't really interest me that much right now. The bummer is this reminds me of late 2020. Like in we were no, not late. Yeah, late 2020. So where basically we had this list of stocks. We wanted to it was right before we started the fund. A lot of the prices looked pretty attractive. And in the 4 months that we needed to basically assemble the fund, all the valuations just ballooned. Now I feel like I'm in the same situation again. And I don't want to make the same mistake where I've got this list of stocks in my head and I like them no matter what. And I just kind of close my eyes and forget that the valuations have ballooned. So I think I'm going to end up going a little more concentrated once I start adding to my investments here.
Yeah, and there's nothing wrong with being patient and saying, I'll build out a like if a lot of stuff gets too pricey for me, keep it on the watch list, and over the next 6 to 12 months, like if it's on a retirement account strategy, th- there's not the end of the world. I think it's a good lesson that we're trying to learn from that mistake. Don't make that same mistake again. Rush in, have FOMO. Don't say, "Oh, I'm gonna miss out on this thing." And it's like, okay, yeah, you might have missed out on, for example, Ally Financial, but it could also come back. You never know. 2 months from now, it could be back to $25 a share, and nothing may have changed. But if it doesn't, it's not the end of the world. There are so many other stocks out there, and you just, I think, keep researching until you find them. And yeah, I don't think at this moment, especially because our accounts aren't extremely large as younger people, I don't think it's the end of the world to be more concentrated and deconcentrate over a multi-year period. If you get, does that make sense, Ryan? Am I explaining that correctly? I know we've talked about that before.
Yeah, add companies gradually. Like you don't have to set your portfolio and then add money and do it equally across all the positions. Like you can, well, I'm talking to myself here, but I can go kind of two or three companies at the start and add new companies over time as kind of new money comes in. But
You got a
I don't know.
question?
Just bummed. I'm bummed that I'll have to be more selective. It felt like 6 months ago we had like we were kind of rolling in ideas, and it was like, where should we put it?
Yeah, it's interesting how that can change so quickly. You mentioned tobacco. Philip Morris International, I think, is yes, the currency is uncertainty, but I do like that business. I think it's rock solid. I think there's just literally low risk there. We have a question from John. It says, Gents, I have a tobacco basket of Altria British American Tobacco and TPB, which I believe is Turning Point Brands. Haven't looked at them for a couple of years, but so I'm not going to talk about them. Seems like they have been finding the bottom and have great dividends and plenty of time to see them grow. Yeah, I mean, look, I kind of like the tobacco stocks if they keep getting discounted versus other stuff versus treasuries that may have lower yield now. Like, of course, I think they're a better opportunity, especially if you're in a non-taxable account and maybe use it as a bond like thing. I think British American Tobacco might be the better one at the moment just because of the price. And,
Ten
you
percent
know,
dividend yield, I believe.
yeah, like, I mean, if you just have to treat it like a bond, that's pretty attractive, I think. And I really like the idea, especially if, as you mentioned, if we go into a true rebubble period again, where we see stocks get even more expensive on a general basis, and a lot of the stuff on our watch list, it's like, okay, I don't want to buy this thing. Well, instead of sitting in cash or treasuries, you can sit in this thing and you can get an 8% return, and maybe there's, you know, some better opportunities out there. But obviously, there's
If
still risk to those businesses too.
if we do rebubble, I've I'm going to make some changes to I'm going to make some changes to my investing approach. I'm going to make sure GARP's going out the window. Uh,
Yeah. No, growth at a reasonable price, not 40 times earnings, growth at a reasonable price, according to Buffett and stuff like that. That is, 15 times earnings, stuff like that.
I know it's so funny to think about that Buffett quote where it's like much better to pay a fair price for a great business than a great price for an okay business kind of thing. And everyone's like, okay, yeah, like
40 times earnings.
then it is time to it's okay to buy Shopify at 50 times sales then because like, Buffett said this. It's like, remember C's Candy? What, like, didn't he pay like 12 times earnings?
Don't know. I don't know the exact one, but yes, that's what he means and has meant about a
And that was
fair
their
price. It's about 10 to 15 times. Yeah.
compounder that everyone's like, look what C's did. It's like, yeah, that was 12 times earnings. We're talking, I don't know. I don't want to get back to that period, but yeah, I think I would probably, if we're doing it again, tobacco is probably a good basket.
I
I
mean,
like,
look, if valuations across the board explode higher and tobacco doesn't move, and then treasuries are much lower, I mean, yeah, those are all else equal. I think those are better opportunities.
yeah, I agree. The it just, I don't know. I don't want another rebubble. It doesn't sound fun to me. I like the market that we've had over the last 3 years.
Well, we could just embrace it on the podcast and just talk about all the stocks
It
because
is
the,
good
the
for
listenership
listenership.
goes up.
People care more when stocks go up. I just I think tobacco stocks is probably a good place to be. We can talk about all the hype stocks on the show to draw engagement, but my portfolio will reflect probably none of that. Um, so I don't know. Yeah,
Yeah.
British American, I like that. Shareholder yield is like 14% right now. It's pretty attractive. And they're not going to have to pay that much taxes because of that ridiculous goodwill write down they had.
Yeah, which was basically already priced in. That reaction to that was a bit strange. Question from Tyler. We got two. Actually, got three just added here. Have you guys looked into home builders? Yes, we did last year. Probably at the right time, but don't really like the business model too much. He says they might be interesting here given the long-term housing shortage in the States and a potential trend back towards affordability. Yeah, one thing is I'd say on the housing shortage is the predictions from and the estimates from all of the different economists are so wide that I don't think any number is reliable. Some people say there's a 6 million housing shortage, some say there's no shortage, some say it's a 2 million units shortage. So I would say that no one knows exactly what the shortage is. There's too many variables here. And also we don't know what immigration is going to be, what population growth rates are going to be, all that good stuff. There's way too many variables. But at the right price, a good home builder like NVR, I think, is a durable business. They have a little bit of an advantage model, but I would say in general, after looking at all those companies, the cash flow, I think, like the cash flow conversion and how a lot of stuff gets stuck on the balance sheet is it's a concern to me. It's not the type of business I like. I like one that has consistent cash flow generation. That's just kind of my style. But
Well, it's not with NVR, it's different because of the way they buy the land, but like the options agreements, they don't have the inventory on their balance sheet that much. But
yeah, it's better, but it's still, if I remember, still not ideal. I could be
yeah,
remembering them wrong though.
it yeah, we missed. I think we missed on NVR. And but we had reasonable, I mean, what stock's probably up double or triple since we looked at it. But I remember we were thinking basically like we don't know what home prices are going to do, and if home prices come down or their average selling price comes down, then we're in a basically it's going to be a we don't know what's going to happen to margins. But I think we were looking at it too much on like a general basis, like housing prices across the country. Whereas some of these are, if you're like a first time move up or a first time home producer, like I think NVR is in certain geographies, I really don't think the general housing environment's going to affect them that much or affect the average selling prices, which it seems to be the case, and they've done quite well in spite of it. So yeah, I think house home builders. I wish we would have. I wish I would have considered them a little more seriously back a year ago. Probably a little bit more difficult now, but yeah, I like them. NVR, DFH, or Dreamfinders Homes. Both those are good. The other thing I will say though, they the options model that they use, where it's like, how, what's the term? It's like a land option. Basically, they don't buy the land, someone else holds it. They have the option to buy it basically right before they sell the house. So, and then they pay like a fee for it. I like that, but it's not that unique now. Pretty much all the home builders, except for a couple, implement that in some way. So I'm not sure that's like the big advantage that it has been for NVR since like 2000. So when I expect the returns to mirror what NVR has produced over the last 2 decades. Other questions here.
Oh, I was
Oh,
gonna say some on home builders before.
go
For
for it.
reference, MVR late last year, PE was below 10, and now we're back up to about 15. I think home builders are just all else equal. Obviously the moat with MBR seems good, great management, all that good stuff. I just don't think it's a good it's not the industry that it's just not the best industry.
Yeah, maybe. What, you just don't like the working
I'd
capital
rather have
stuff?
something that's a take rate. Look, all else equal, I'd rather own Airbnb, Booking, and Expedia. Maybe not Expedia. I don't know.
But
Like you want to take rate on stuff like that.
but all else
I'd rather
isn't
own Visa,
equal.
MasterCard, American Express. Like don't I want asset light businesses. All else equal.
I
And yeah,
know,
these
but
can claim asset light,
all
but
else is never equal with these. You know what I mean? Like these valuations are never the same.
American Express.
Sure. Okay. Amex, I'll give it to you. And American Express at this point is probably more like 20 times earnings, but like
Right.
Visa and MasterCard, those aren't trading at those are not trading below 10 times ever.
True. True.
The John says, Brett, what do you consider the best industry, the most asset light?
Well, like, oh, well, the best industry. It's hard to maybe sector is the best way to do about it. I mean, the payments networks are extremely attractive. I would say that any sort of online platform is also extremely attractive, right? Like YouTube, Instagram, stuff like that. That's, I think, fantastic. It's kind of hard to go off the top of my head, but I love the kind of e-commerce platforms around the world too. Amazon, Coupang, Mercado Libre, not Jumia. That was a scam. But uh yeah, I think those are good. Any
Not a
that come off the
scam,
top of the head for you?
failed. There's what did Trevor Milton say when they in his trial? It was like I said like trying to be an entrepreneur isn't a crime. Like
Yeah, exactly, exactly. Well, committing crimes is a crime as an entrepreneur. Other one. Um, CPG businesses that now some people might argue Ozempic is about to disrupt this whole thing, but this brings us back to the nicotine pouches, why we were so attracted, why we've been talking about them for 3 to 4 years. We actually just had a good interview with Spencer Sabelli talking about a kind of way to play that with this company that does online stores within that. But yeah, I think those type of businesses are attractive because you have a consistent customer with a specific brand, specific taste, and it can be durable and the margins can be good, and you bring cash out of the business that you can return to shareholders. I mean, just think of the businesses that Buffett has bought over the years, right? See's Candy, American Express, Coca-Cola, Apple, and then also high quality, if we go outside of asset light, are ones that have just an infrastructure moat because obviously those e-commerce platforms aren't asset light, but the vertically integrated like e-commerce platforms such as Coupang and Amazon and Mercado Libre, I think are fantastic businesses as well in the best industries where it's you're going to build out one set of infrastructure and then the economy or civilization is not going to accept 10 because who's going to build 10 railroads through all the towns, right? That's why the railroads are also highly attractive
yeah,
businesses too.
it is. Yeah, I was looking through that Mobison list. It's like his wide moat business list, and it's 98 companies. And I remember just going through each one, thinking the big commonality and the big advantage between a lot of them is either scarce assets. So like there's a lot of airports and stuff like that where it was probably purchased from a government or like there was like a government auction for them way back when, especially with the Mexican airports. Scarce assets where either you can't reproduce it or it's not doesn't make any economic sense. So airports is one, railroads you probably can't at this point reproduce it. And cell towers is another one, American Tower, Crown Castle. There's so many zoning rules that it's hard to reproduce the
Yeah.
network they've built. And then the other one was a lot of the companies that showed up on this wide moat list. It was just companies that had built out massive, either a massive logistics footprint or tons of infrastructure over like 3 decades. Amazon's probably the one that comes to mind here, where they have been plowing so much money into CapEx over the last 20, what, almost 30 years now, that it's so hard for anyone to reproduce that. And even if you do, like you have to have the revenue to back it up in order to finance all the capex. Like it's, I think yeah, situations like that, like you said, where companies have built up massive infrastructure over a couple decades. Those are big advantages. And that list, the average returns were all like rock solid. I
Yeah.
think a lot of
Yeah,
it has to do with that infrastructure.
the big question always as an investor in these companies is not what was the moat in the past, it's will the moat stay the same? Will the moat deteriorate? Will the moat expand over the next 5 to 10 years? As and I guess we're talking luxury this month. Those are also wide moat businesses, I think, that are a great industry to look at, although there's only a few companies out there. A lot of them are private. And then the last one I will put down is what I would call enterprise or worker software. I would maybe specifically put it more to like employee core software that people use within an industry. The core examples here for anyone knows like Excel, right? That's an incredible business, just giving the switching costs, giving what I would describe even as a network effect, where if you're doing any sort of file sharing, especially within the cloud and all the shared file tools that everyone has now. And then another example is Autodesk products, which are fantastic businesses because again, the shared nature, the switching costs, the learning curve. You also have Adobe's
The resume
products.
moat.
The resume mode. Yeah, it's a good. Yeah,
If you're
exactly.
putting
Yeah.
it on the resume, if you have to put it on the resume to get into the workforce, like okay, I'm proficient in whatever your specific industry's software is, then it's got to be pretty hard to replace because the company probably has a whole bunch of whatever it is, architects, engineers using the same software. They just don't want to switch. So I think I don't know if that's can we say we coined that the resume mode?
I think other people have, but I think we've talked about that a lot. And yeah, I don't know if that specific term. Maybe you can take claim there. Salesforce type stuff is a good example, although all these companies seem to spend a lot and have frustrating management teams and capital allocation. But
I will okay. Best businesses, highest quality. I do think software is in there. There is just a plague of expenses. There's an issue. It's spread throughout the entire software industry. And I've now having worked in a software business for like 3 weeks, I gotta say, these things are good businesses. Like at the core, the incremental cost once a customer has signed on is very low. Like if you have a sticky product or a sticky platform that your customers are going to continuously use, very, very good businesses. And I just have to believe that Salesforce, Autodesk, Adobe, they could have significantly higher margins. They just have an expense problem.
yeah, I think Adobe might have extremely high margins, so maybe we're tossing
They
them
have
in there when
40,
they should be. But
40%. They have 40% for cash flow margins or operating cash flow margins, but they spend 13% of sales on like stock-based comp.
yeah, let's look at true operating margin. How about that? Gap,
I think it's like
which no one likes to talk
27,
about.
27,
34,
34.
34. Although it's a little, yeah, it has trended higher over the last 10 years. So kudos on them. All right, I have another topic. Chinese stocks. Seen a lot of talk about them lately. Because, well,
China's
you'll
back.
never guess. What?
China's back.
No, the stocks, you'll never be surprised, are falling. If we look at, let's look at the price of both the favorite ones among all these people out there. JD.com and Alibaba seems to be the value investor camp. Over the last 5 years, they are both pretty much to all-time lows for the last 5 years, and both are down about 75%. And look at the PE ratios. Let's get the number here. Obviously, these can be wrong. We're just an aggregator. Both of the PE ratios are around 10. I think that's a proper discount for the geopolitical risk, right? Doesn't mean I don't want to buy these things, but when people argue that like these deserve to trade at 20 times earnings, I just don't get the hype around these things still. Like Of course they should trade at a discount, right? Like the country is saying,
They traded at a discount 5 years ago. Where did the cash go?
yeah,
I think they should. Yes, you're right. They deserve to trade at a discount. I honestly, if you look at the cash flow from these businesses over the last 5 years and see where they ended up, like where most of the cash went, I, I'd be curious. I
yeah. Well,
don't think it came back to shareholders.
yeah. I mean, if you do all the sum of the parts stuff with Alibaba, uh, basically, so many people argue that it's the cheapest large cap stock in the world, and I'm kind of like, yeah, that makes complete sense. It's like, do you follow the story, and do
Wasn't
you
the
follow
DC,
what country they are operating in?
who did the I think it was Willis Cap on Twitter did like here's my Alibaba DCF and it was like all the cash flow that it generates over like 10 years. Then it said like cash flow paid to government, cash flow available to shareholders is like $0, like 100% good, whatever. It
Yeah,
just feels
yeah,
I, it's pretty easy to just say no for me with China. I've never understood like I don't know. Doesn't
yeah. There's a
doesn't really
very
interest me. And then on beyond just the geopolitical risk, it's a very different like consumer. They very different habits. It's a country I've never been to, a country I frankly don't understand that well. And there's been so many like fraud cases that for me it's a little hard to like if a company's saying this is how relevant we are within the country, here's our numbers, here's our revenue, here's our market share, that kind of thing. It's hard for me to say like, oh yeah, I believe that. It seems valid because I you don't have any boots on the ground. You don't get a sense of whether or not their relevance is real. You saw that in a big way with Luckin Coffee. Like they talked about stealing all the share, and now the stock's done quite well since post fraud. Uh, where it's like, I think if you were there, you could maybe understand. You would maybe have a better sense of whether or not all that success they were hyping up in their investor presentations was legit.
yeah. That's fair. And I will say, if people are comfortable with the geopolitical risk, I don't understand why you wouldn't just buy Taiwan Semiconductor. Because if that's what you're comfortable with, why don't you buy the one, maybe the widest moat business in the world?
Doesn't have the discount, maybe? I don't know. I honestly don't know
Well,
what
maybe not
Taiwan
anymore. Yeah.
Semi's. I don't know what their multiple looks like. Maybe it's worth the. I don't know. Maybe it's worth the risk. 10 times earnings,
Yeah.
Alibaba. Like
Maybe it is now.
if things don't get worse for them, and if geopolitical, I don't know, turmoil situation is kind of at its worst, there could certainly be good returns there.
Yeah. But I think this is a much more like what I think they should be trading at versus before when they were at premiums to Western democracies.
They were at premiums
Well, at some point, yeah.
just because of the growth rate. Uh,
China, people love China stocks like 6 years ago.
we
Yeah.
brought up Taiwan Semi and we talked about Buffett earlier. Did you see the stuff about it's like a Berkshire lawsuit? It's not the one, it's not the issues that they're having with the pilot drama, but it's like this. Apparently, Buffett entered into this agreement where he owns he owned like 40% of some business, and it was basically in 6 years we'll buy the remainder from you at 10 times earnings. And now, which they said in advance, and now they've got these like the management's trying to boost short-term earnings for the year as much as they can. Like they've got
Th
these deals.
this is the pilot thing, right?
No,
Well, that's exactly what's happening with pilot too. Or
wait,
maybe
what are you?
that
I
might be.
thought
I think
I
that's the
thought
name
they
of the
weren't like
business.
the pilots weren't getting paid. No, I thought that was like the NetJet drama. Oh, okay.
Oh.
There was some NetJet drama with the pilots that I saw
This
some
company is
ad on.
called this company. One of its names is called Pilot, so that's where the confusion is.
Oh, okay. So yeah, maybe it is the I wasn't sure what the company's name was, but it's so bizarre to say like we will pay 10 times earnings for you in 2024. It's like there are so many ways to massage that number. So
Yeah.
it'll be funny to see how this plays out. Basically, they I believe Berkshire sued that I don't think it was the person running the company because they technically had majority ownership. So Berkshire had their own CEO in place, but it was the outside owner had all these sweetheart deals with like particular executives or managers that said like if you get these deals over the line before the end of the year, I'll cut you, I'll give you an extra bonus here or whatever. So could be, I don't know. But on the flip side, I think they sued Berkshire for saying that Berkshire was trying to depress earnings because of some accounting gimmick.
Yeah, like we're using real accounting now, guys. I think uh the easiest way to fix that is just have a third party auditor, right? They just decide it. That would just make sense in these type of deals. But yeah, they are sticky situations. I think that'll be interesting to follow, and it is a classic Buffett deal. I guess this is one of the few where he missed, he always says that I do handshake deals with people that I think I can trust. I guess this is one of the few that he made the mistake and maybe didn't went with someone that was it could have been Berkshire that made the mistake, but what was someone that was a bit sleazier? That could be the case here because typically they do these type of deals, which are more handshake-ish agreements, but it's with the culture of trust, the seamless web of deserved trust, as the late Munger loved to repeat so
Yeah.
eloquently.
The I wonder if he's ever done deals like this before where he says how much like what earnings multiple he will pay in advance because it's kind of a like you're just bound to run into conflict. Like obviously they're going to try to juice that earnings figure and you're going to try to depress it. Like I don't know. It's not
Yeah,
it's
the
not going to end
incentives.
well.
It's a yeah, the incentives. Okay, we have a follow-up from Tyler saying he just checked. Taiwan Semi is at a EV to EBIT of 13.3, trailing 12 months. I think that's a better bet if you're comfortable with the geopolitical risk. Nice. I'm not comfortable. I don't own it, but I think you know what I mean? Because
Yeah.
this business is more understandable for Western investors, I think.
Yeah, probably. I was looking at like I don't know if TSM would fit in here, but I was looking at a dashboard, like a general dashboard, general watch list, and the companies on that were Berkshire, Google, Microsoft, Tesla, Netflix, Apple, like the Magnificent Seven plus a couple. I just thought if that was my portfolio, I would stop investing. It's so boring. I find that so
Yeah,
boring.
yeah.
Just buy an index and go do something else. Like it would just, I would have no fun. Like the fun of trying to find something that's under talked about, under discovered,